Every single high quality trade starts with framework off of the higher time frames. And this is not something that you need to know many concepts to get right. All you need to know are highs and lows. But the question still remains of which highs and lows do I actually focus on? And this is where the idea of relevant swings comes into play. This is something that is the absolute foundation of my system and is included in every single trade that I place. It tells me if there's opportunity in the market, where the opportunity exists, and which side of the market I should be focused on, while completely removing all the unnecessary noise. Getting right into this, it's first important to understand the actual goal of relevant swings. The idea is that we want to remove the guesswork, the doubt, the ambiguity from identifying certain highs and lows from the normal way that most traders would approach this. We're going to be focusing on the highs and lows that exist at the extremes relative to the current market. And what that does is that when something is at the extremes and the market engages it, we know without a doubt that what happens there is meaningful. And you're going to get to that understanding of how we identify them using a very simple 3-step process, but also the simple reactions that we look for at these points that give us a bias going forward. The problem most traders face when trying to identify highs and lows is that they are all over different time frames. They're trying to mark out session highs and lows above and below opening prices around all these different times. These are things that add confusion, they add doubt, and there's no certainty in the sense of what we should be looking for. We are going to be completely removing that noise by doing a few simple things. First, we want to be focusing on the right time frames. We are only going to be using the daily chart for identifying relevant swings. And as you can see here, you have the option to go below where there's the 4-hour and the 1-hour, but that gives you too much detail. When we go above the daily to the weekly or the monthly, that is too little detail in price. The daily hits this sweet spot for intraday trading where we are going in and out of the market within the same day, holding trades for a few minutes to a few hours, getting in and out. This is where we want to be focused on because it gives us enough detail to be fluid in bias, but also not giving us so much detail in price that we are seeing too many things at once and we're not actually able to identify the areas that matter. And on the opposite spectrum, the weekly and monthly, it is too high of a time frame to see the current development, to adjust a bias, to go day by day, and it's really not something that you want to be focused on for day trading. The first and truly most important concept of identifying relevant swings is going to be understanding what a failure swing is. The concept of failure swings is extremely simple. It's when we set either a high or low in this current example in the market, an initial low is formed, and following that, we make deep runs back into that initial low following that point. And these deep runs that get back into that low are considered failure swings. The reason being is that when we create a low in the market that could be reversed off of, it should not make deep runs back into that point. Once price reverses, it should expand away, make shallow retracements. That is a sign of an expansion or a continuation. When we make deep runs back down into it, that invalidates that point of reversal and shows that lack of wanting to turn in the market. So anytime we see an initial low formed like this here, that is the first low formed, then we have price come up, retrace deep back into that low, and then again deep back into this low. These deep runs back in are considered failure swings, failure swing, and that is the initial low in the market that we would want to be focused on. This here is what we would consider the extreme of the lows. So this low is not a failure swing to any other daily low to the left, but we have these failure swings that follow it. We want to look for that initial high or low that was formed, and we can show you an example on the other side of the market. Here we look at the highs. We have this initial high that was formed, the highest high in this current range, and then following that, price made deep runs back into that high. Deep runs back into it, and it created a failure swing, another failure swing, and that final initial high. And again, this point is what we would consider the extreme of highs. These are the points in the market that we want to be focused on. Anything that is considered a failure swing, these deep runs are not considered, and they would be irrelevant for us to be noting them out. We simply block them out of our perspective and focus on the extremes. Just to reiterate that point, Any reactions that we see at those failure swings, not the extreme highs or lows, is considered irrelevant. We don't want to care about it. We don't want to focus on it because that is what we consider the noise that we are trying to filter out. The extremes in that market is where we know without a doubt that once price engages that point, the reaction there is going to hold weight and significance for what should happen going forward. The second step that we have to understand in identifying daily relevant swings is price separation. So you understand what a failure swing is when we have that initial high or low that was formed, and any deep runs back into it are considered failure swings and should be ignored. Our focus remains on the extremes. Now when we bring that to a real daily chart, we have to understand price separation to help us identify which highs and lows are going to matter. Here in this example, we'd be on a daily time frame, and our first instinct should be, where are the extreme highs and lows of this current range? We're going to be focusing on the lows here, and we can just go one by one. We have a low that is set. Is this an extreme of the lows? No, because this is just a failure swing to this next daily low. We have that deep run back into this initial low that was set. So we are not going to note this out, but this in itself could be considered an extreme of the low. We look even further left, we have another daily low. Would we consider this an extreme of price? No, because it has this deep run back into this initial low. This here in itself is not a failure swing to anything else to the left, so this could be considered another extreme of the low. Here we have both of these potential relevant lows noted out on the chart. This low here, this one here, ignoring the failure swings, focusing on that extreme. The question here, and this is where the idea of price separation comes into play, is that we want to be thinking, in the case that the market engages this first and initial relevant low, would that create a failure swing to this next relevant low? That is the idea that we really want to be taking into account. So this is a visual of that price separation between the two potential relevant lows, and this would be considered valid separation. The reason being here is, again, if we were to think about price coming down, manipulating this relevant low and trading higher off of that, would we just leave behind failure swing lows? And the case would be no, because the distance between these two daily lows has enough separation to the point that this is not a deep run into that next daily low. So they remain separate and individual of themselves. So at this point, we'd be working with two separate extremes of the market. This is engaging a relevant low. And if this were to be the case of a manipulation, because it didn't leave failure swings off the lows, which we know is irrelevant, and another rule is we don't want to trade away from failure swings, then this would be a valid manipulation. This is a valid relevant swing, and we could trade the continuation away from this low. Now let's think about another example. We're going to go through that same exact process, again, focusing on the lows for these here. We're going to be looking at this initial daily low, thinking about, is this an extreme of the lows? This would be no, because we look to the left and we have another daily low, that initial low that we went really deep back into, creating a failure swing to this low here. So we have a potential relevant low in the market, some separation to this next one, but we look to the left again. Would this be an extreme of the lows? No, because this is a very deep run back down into this initial daily low. So we have two potential daily relevant lows here that we could think about marking out, but we have to bring in that idea of price separation. With these 2 points now noted out on the chart, we have this visual that we can consider. We want to again think about, if price were to come down and engage this first relevant low, would that just create a failure swing to this next daily relevant low? Because in that case, if we do have a failure swing, then we can't trade this to the upside. We have an irrelevant point because, again, failure swings are irrelevant and we completely filter them out. So let's consider this here. Again, this is our separation visualized, and this would be a case of invalid separation between two potential daily relevant swings. Here we can envision price trading down into this potential relevant low. That run only creates a failure swing to these next daily lows, and that changes the dynamic of what we would be considering a reaction here. As we note this out, this only creates a failure swing to this low. This low is just a failure swing to this low, and this is the actual extreme of the lows. This is our relevant swing that we want to be thinking about, because the price separation here is not enough that a reaction here would be considered relevant only because it just ends up creating more failure swings. And when we have failure swings off the lows, we can't trade that higher, and failure swings in themselves are irrelevant and we should not be focused on them in the market. We want to point our focus to the extremes. And if the market were to come down and engage here, then we would consider that reaction valid and something that we would weigh heavily for what should happen going forward. The third and final step of identifying relevant swings on the daily chart is we want to set a look back period. What this means is how many daily candles in the past we're actually going to consider and look for our daily relevant swings. That number for us is going to be 30 daily candles in the past, not 30 calendar days, 30 daily candles. And you can draw back on your charts and use that range to say anything within here can be considered for noting out and identifying relevant swings, but anything that falls outside of this 30-day look back period, we are not going to be considering as relevant at all, regardless of what price looks like. And the reason for doing this is to not get caught looking so far back in the past action of price that you're starting to look at highs and lows that are months and months and maybe even years in the past that don't hold the same significance on the current market. We want to be focused on more recent times. Again, we're calling back to this is day trading. We're focused on the daily chart. We want to be fluid in bias. We don't need to be taking in that much information, so we're going to cut it off at 30 daily candles into the past. If you want to know how to do this quickly on your TradingView chart, you would go and hover over the current daily candle, hold shift on your keyboard, left click on your mouse and drag to the left until you see -30 on the daily candles. You can put a line there if you want or just get a general idea, but that is going to be your 30-day look back period where you look to identify daily relevant highs and lows. So just as a recap, to understand relevant swings, it's not an overly complicated process. If you understand failure swings where we have initial highs and lows that are set in the market and then we have deep runs back into it, those deep runs, what we call failure swings, are irrelevant and we don't want to trade away from those areas in the market because they are unestablished reversals. But when we focus on that extreme in price, that is your relevant swing. Then we bring in the idea of price separation. When you're looking at your daily chart and you have all these candles here, you're identifying potential relevant swings using your idea of failure swings, the extremes of the market, noting those points out, but thinking, is this enough separation between one daily relevant swing to the next that if I were to engage this point, is it the true extreme, or will it just create a failure swing to that next daily high and low? We would not want to be considering that reaction. Then finally, we have our look back period, looking 30 daily candles into the past from the current day. And that's that range you're going to want to be focused on. Anything that falls outside of that, you don't want to be considering at all. Now that you have your foundational knowledge down on how to identify relevant swings, we're going to move into some real chart examples. These are daily charts from actual markets that we're going to walk through, not only to show you how to identify them in different scenarios across the chart, but also showing you the reactions and what that means for price going forward, because that is how you set your bias. Starting here, it's important to remember that your first instinct should always be, I want to look left off the highs and the lows, and I want to be seeing if I can identify any extremes in the market that the current price has already engaged and what did it do there, or can engage soon in the future, because that's where the opportunity exists. When we see here, we have an initial low that is close in the market, so I could potentially mark this out, but I also want to draw my eyes further left. We have a potential deep run back into this initial low that was set here. The question is this a failure swing? The potential is to say yes, but we could even consider the idea of invalid separation, because in the case that this following day were to come in and manipulate that low, what would that do? That would only create a failure swing to that extreme and initial low in the market, and we do not trade away from failure swings in that sense. So this would be invalid separation. So what that means for us is this is not a relevant low. Instead, this is the true extreme of the market that we want to be marking out. Now, once we see this reaction at this relevant low, we clearly have a manipulation. So the daily candle drops down into this relevant low, and what it does there matters because this is the extreme, and we can think without a doubt this weighs in the market. we have a manipulation and a strong close in the opposing direction. This means I want to be trading away from this low, and this is the time where I'd be looking on the other side of the market for a potential draw or something to trade into. We look left from this high, and we see this first initial daily high. Is that the extreme? Clearly not, because we have that deep run into this initial high. So this is not a relevant swing because it is only a failure swing to this initial high. This is the extreme that we would want to be noting out in the market. And what we have here is this following day, we could be trading the continuation, assuming price should draw up into this high. We have a failure to fully continue. There is likely an opportunity to trade up close into that high, but this following day, if it either fails to confirm or we don't trade that opportunity, what we have on this following day is still a one-sided opportunity. We've left failure swings off the highs because we look here, we have deep runs, but not quite going through this initial high. So we have failure swings off the highs. That is not only a draw, but it's also something meaning that this following day, we can't trade away from this high because it's left behind failure swings. We still have this low that is a manipulation. So we want to be thinking expansion to the upside. We are still assuming continuation up into this point here. The question remains, how do we actually get there? We look to the left because now we're considering the lows. We look at this daily low and we could note that out because we know inside of this daily candle, because of how close this closed to that daily low, we know it's not likely that this next day is going to turn higher without taking this out. And we also think this is a daily low with deep separation between this next daily low. So this is valid separation. This is considered the extreme low of the current range, and that is a relevant swing in itself. So we see this next day come through, open into that low, forming and expanding off of that up into the failure swing highs. This is valid framework for us to be using this as a relevant low and this as a relevant high. Failure swings above. This is a one-sided expansion that we would want to be trading. Again, the following day, we still have these failure swings above in the market. We could trade the continuation, assuming price should draw up into that high, and that would be that completed move. And now we would reset because we've reached that opposing relevant swing. Just to clear this out for a more simple perspective, we know we have this daily relevant high that is now being engaged, but we can see later in this price action that we start to develop these following days that don't quite continue or reverse. We're creating new failure swings in the market. As we can see here, we have this following day that creates a deep run into this initial high. So we start to create failure swings off the highs. Same with this day here, deep run into this high. So we're creating failure swings, which are not relevant, but because this is the initial high in the extreme of the current range, this becomes a new relevant high. Now we look off the lows. We see there's a lack of continuation. We're creating more failure swings off the lows. We have a deep run down into this low. This is a failure swing to this low here. Now we can start thinking about valid separation again. We have this next daily low that we can mark out. Is this considered valid separation? And the answer is yes, because as we see this manipulation take place on a potential relevant low, we have that deep separation between the 2 points, that this low is not creating a failure swing to that next daily low. So this here is a valid manipulation. This is a valid relevant low, and we can use this reaction to consider this meaningful in the market. And we again see price drop down into this relevant low, expand off of that as a manipulation. And then we have a second type of reaction. So manipulation off the low is how we see price trade higher, but we are also getting a close through this daily relevant high. When we see a closure through a daily relevant high or low, that deep closure, this is where we can assume continuation because we have both types of reactions taking place. The relevant low has a manipulation. We could trade away from that, but the relevant high also has a breakout signature where we have that deep daily candle closure through. And you see these following days starting to continue. 1 day of continuation, 2 days of continuation, and we just see that trend continuing on from this point. Zooming out on this example quickly, you start to see the logic come together of simply using failure swings, separation in price, and the type of reaction we're getting here to navigate this price action and filter out the things that are not relevant or should not be considered in the first place to even be trading within certain days. Again, we have this relevant daily low. This one is not relevant because of the lack of price separation between these 2 points. The reaction at this relevant low shows a manipulation. And when we create failure swings off the highs to this next daily relevant high, we cannot trade the downside. So we look for any ways for price to draw up into that high. This low has a lot of separation to that next daily low. That means this is a relevant swing on its own. And we see price manipulate that low to then trade higher the next day, continuing into this relevant high. Then again, we start to establish a new range where we create failure swings to both sides of the market, and we would wait for one side to be engaged and then judge the bias from there. We have a reaction off of this relevant low, which has valid separation to this next daily low. So this is a relevant swing, manipulation, continuation through the highs. That deep closure through is an additional confluence, while not necessarily needed in this case because we already have the manipulation of the low. We also have a deep closure through this relevant high, which we then see follow through on the next 2 days of more continuation. And that would be biased to look for inside these days, continuation long setups. Moving on to our next real daily chart example, I want to focus in on one specific point here. We're going to look at this area in the market, and we're going to be thinking about what is the extreme of lows when we're waiting for a certain type of reaction for this market to become actionable and directional. We see this low here in the market. If we were trading or looking inside this day for extra context on what the bias is, we would think about this low. This is just a previous day low. And when we look left, there is not another daily low until down here and down here. So we have a lot of separation to these next daily lows. In a case like this, previous day low becomes the relevant swing. So we have this noted out here, and we're waiting for a reaction to take place. We see that this next day comes in, trades down into that low, and closes back up into the range. This is something that would be showing a manipulation. When we trade down into it and back up, closing into the range, that is a sign of a manipulation. And valid manipulation means reversal into continuation. For some added detail to this particular situation, there may be a case like this where this daily closure may not be convincing enough for you to be one-sided on this market or for you to fully call this a manipulation yet. We could wait for one more day of context if needed. So we have this day here. When we see the market expand away from this low that we could consider a potential valid manipulation, that would be your full confirmation to say we are expanding away from this low and we can trade the continuation. And when we look left, we're looking for that opposing relevant high. We draw our eyes to the extremes, deep runs, all the way until we get to this initial high. That is your opposing relevant swing. So that is your draw in the market. You could trade this day if you initially saw this as a valid manipulation, but once we see that expansion away on the daily chart, we would trade this next day as a continuation, all the way until we reach this opposing relevant high in the market. And what do you see as we draw up into it? We have these expansion days that can be capitalized on, but once we engage that opposing relevant high at the extremes, that's where you start to see opposing reactions. This here could be traded to the downside, or it can be your sign to say, I was trading the continuation prior. Now I should be stopping that bias because I know when we react in this way, that may be the pause in the trend and I need to reassess my bias at this point. Or it may be creating a new opportunity to trade away from this relevant high, seeing this as a manipulation. And now I want to trade the downside in the other direction. Moving on to the final daily chart example, I want to bring your attention to this area here. If we're trading in this market, again, that first step is always going to be looking left off the highs and the lows, looking for potential relevant highs and lows that we can note out at the extremes that can create potential opportunity, or maybe already setting a bias if we've already had that reaction. So we look off the highs and we see a deep run into an initial high that was formed. This is a failure swing, so I'm not going to note it out. This is the initial high. This is the area that I want to be focused on in the market. Then we look to the lows, where I see this current daily low is a deep run to this next daily low. That is where we would call it a failure swing. So this low is not relevant to be noted out. We are going to use this low as a potential relevant swing because we look below, we have deep separation to these next daily lows here. So this would be an independent daily relevant low that we could note out in the market. And we also have these areas below. While price may not engage here, it's still worth noting them out in the case that this becomes a target in the future. So it's still something that you'd want to have on your chart. Moving back up to this area, we see price action starting to play out. And again, we're making even deeper runs back into these highs. So it's creating failure swings off the highs. And as price draws lower, because we have these failure swings off the highs, which is an unestablished reversal, something that isn't giving us the context for price to move in one direction, when it starts to fade away from these failure swing highs, we are not trading this downside or attempting any move. And on the other side of the market as well, because we also have failure swings off the lows up until this relevant low here, we're also not trying to assume or attempt any upside move. So this is what we consider a range in price, because we have failure swings off the highs and off the lows, and price is trading internally in between those points where we are completely neutral and are not trying to establish a bias here until the market either reaches this relevant high or this relevant low. Until that happens, we are completely hands off. Eventually, we do get price first engaging this daily relevant low. And what happens there, because this is the extreme of the market, we know has weight and we know that it matters. Price comes down into that daily relevant low, and we see that wick formation again, trading down into it, closing back up into the range. That there is a valid manipulation. Again, we have that separation, so this is not creating a failure swing to that next daily low. So valid manipulation at a relevant low. That next day, because we've already reversed and established it, we would assume continuation away from that low. And that's what we get here. So that next day bias is bullish. And because we have failure swings off the highs, we're not going to be shorting anything here. We have a target, a series of failure swings that is drawing our eyes back up to this daily relevant high, which is an opposing objective. So we are going to hold that bias until we reach that point, or some new structure is formed that can reshape this scenario. But as we stand, we're going to look for that continuation. That next day has a potential opportunity from that open, drawing up into that high. But as it fails to do so, this leaves another failure swing. So we are not trading the downside the next day. We are wanting to think, what needs to happen? What do we need to see for price to draw up into that opposing relevant high? We have a similar situation from that first example where we have failure swings off the high. So we're not shorting. We're still assumed in the continuation, but we have a previous day low that has that large separation, valid separation from these daily lows. So this in itself, previous day low, is a relevant swing. And when we see price manipulate that low on this following day, open, low, and then expansion, we can trade that move. And this is our framework for this day to trade up into this high. So that would be your bias, that would be your framework. And we understand the opportunity on this day occurs at previous day low, manipulating that to finally get up into our opposing objective of this high. So this is an example of a range in price where we start to create these failure swings off the highs, failure swings off the lows, and we are waiting for the extremes of the market. And we see true reactions that actually matter. And it gives us a bias and a framework of where to look for that opportunity and how to know which lows we should be focused on to get up into the continuation for this high, that opposing objective in the market. You now understand the 3 core steps to identifying daily relevant swings. We want to know what failure swings are and how deep runs back into initial highs means we want to completely ignore the failure swings and focus on the extremes of price, because that's what actually matters. And reactions there hold weight in the market. The second is valid separation. So when we're looking on a daily chart and we find potential relevant highs and lows that we could be using, we want to be considering the separation to that next daily high and low. So in the case that we do engage it, we're not just forming new failure swings. It is actually separate from that next relevant swing. That's when we know we're working at 2 different extremes. So the reaction there will truly matter. And finally, the third thing is our look back period, only looking 30 daily candles into the past. Anything beyond that, we don't want to be considering it because it's just added noise when we're trading intraday, getting in and out of the market within a few hours. Now, what I want you to do is to go back into your charts and start looking for this signature. You're going to realize how much noise is being removed from the charts, and focusing on the extremes, the reactions there are really going to hold a lot of weight for what happens going forward. And not only can you go into your own charts, but I've posted so many of my trades on my Instagram, YouTube recaps, Twitter from the past that you can go back into and look at the highs and lows that I'm focused on, the ones that I'm identifying, and where my best opportunities come from, because it all starts with the relevant swing. With that said, that is everything I have for you in this video. I hope you found it valuable. There will be a lot more to come on this topic, so stay tuned, and I will see you in the next one.